Good morning, everyone. I think we are going to make a start. So thank you very much, everyone, for joining us this morning. This is a live webinar, although it is being recorded. So by way of introduction, my name is Irwin. I'm a partner at Bracewell in our banking team. I'm a project finance partner. And one of the things that's been keeping myself and my fellow finance partners very busy in the last 2 years, really, is LIBOR transition. And one of the things that is of particular interest in this part of the world, I'm here in Dubai today, is the interplay between LIBOR transition and Islamic finance. We're very pleased this morning to have two of our clients join us today. So we have Edmundo Lujan, who's Project Finance Director at Abu Dhabi Islamic Bank, and Ganesa Kumar, who's Project Finance Director at Aljomaih Energy and Water. And I don't know if fortunate is the right word, but we've been lucky enough, certainly, to have spent a bit of time, Shayan, Najib, who's an associate in my team, and I talking and working with Edmundo and Ganesa on some of these issues. So I'm just going to ask Shayan to give a brief introduction, and then we'll hear from Ganesa and Edmundo.
Hi everyone, thanks a lot for joining today. So I'm Shayan, an associate in the project finance team at Bracewell, based in Dubai. I've been involved with a number of project finance transactions in the region, including conventional, Islamic and co-financing structures. I've been in Dubai for just over 4 years, and prior to that I was based in London.
Everyone, thanks Shayan, thanks Ollie. Glad to be part of this panel on a very exciting and hot topic. I'm Ganesa Kumar, part of project finance team based out of Dubai. I've been in this region for close to 10 years now. Worked on a variety of transactions, technologies, including solar, wind, conventional, so on and so forth. So I think on that change, it's now very exciting to work on new financing aspects of late. So thanks, Shayan.
Hello, good morning. This is Edmundo Lujan. I'm a project finance director at Abu Dhabi Islamic Bank. I've been in the bank for over 2 years now, and working on the project finance space for over 20 years now. So obviously, first of all, give thanks to Bracewell to put together this webinar, and thanks for inviting me. Obviously, the software transition is a reality now, not only on the transition, which is happening, but also on real deals that we are closing. We have, and in Adib, we have closed deals already in software, and happy to talk about it and how we overcome this on an Islamic structure.
Great, thank you very much, Edmundo. And I absolutely agree with what you said, which is, LIBOR transition is a reality now, and in many respects, some of the things that we're about to talk about this morning have kind of already been and gone, in particular the discussion about what is SOFR. So I thought, just to sort of set the scene for this discussion, I would just spend a couple of minutes talking about, LIBOR, what it was and what SOFR is. So LIBOR, very simply, remains an interest rate at which banks lend to and borrow from one another in the interbank market. It's often referred to as the world's most important number, and the reason for that is because LIBOR has been traditionally used as the reference interest rate for literally trillions of dollars of contracts, of US dollar denominated contracts throughout the world. LIBOR's been around for over 30 years, and it came, not necessarily intentionally, but it became the world's kind of default interest reference rate. And its discontinuation, which was announced in 2007, and 2017, and has now come into effect, does have a big impact on business operations around the world. So what is replacing LIBOR? So for the purposes of the discussion this morning, we're just going to talk about something called SOFR. And the reason why we're going to do that is because the majority of foreign currency lending in the region is done in US dollars. SOFR is the secured overnight financing rate. sometimes it's referred to as compounded SOFR, and we're going to come and talk about the difference between compounded SOFR and term SOFR in a minute. It's the alternative reference rate that was recommended by something called ARC, which is the Alternative Reference Rates Committee, and it's a daily rate that's published and administered by the Federal Reserve Bank of New York, so the Fed. It's considered to be a risk-free rate because it's calculated overnight on the actual cost of borrowings, which are secured in the US Treasury repurchase market. Now, I know that's a lot of information, but there are kind of two key points that I just want you to take away before we come into discussion about SOFR and Islamic finance, which is it's a risk-free rate because it's calculated overnight on the actual cost of secured borrowings. So it's different to LIBOR. It throws up a different number. And so that brings into play something called a credit adjustment spread. So we have Edmundo on a bank on the lender side here, and we have Ganesa on the borrower side here. And there's often an interesting debate for people like Shayan and I to talk about whether or not credit adjustment spread should apply to new loans, or, you know, and how you apply it to loans going forward, and so on and so forth. We could have done a webinar on that, but we're not doing a webinar on that today. But I'm just saying the credit adjustment spread is one of the interesting talking points in the market. Although, and Edmundo, I don't know if you disagree with this, and Ganesa, but again, I kind of feel like that conversation, you know, was quite relevant in December, but here we are in May, and maybe it's done and there's already market consensus as to what the outcome is. But then the other key difference, and this is the key, absolute key difference from a structural perspective that kind of makes it interesting for lawyers like Shayan and I, and makes it painful for Edmundo and Ganesa who just want to get a deal done, is that SOFR, unlike LIBOR, is a backward-looking rate. And so what that means is that with LIBOR, when you're a borrower at the beginning of your interest period, 1, 3, 6, 12 months, whatever it is, you know how much interest you have to pay in 6 months' time because you've got this number LIBOR that's a forward-looking interest rate. With SOFR, because it's based on actual transactions that have happened, it's a backward-looking rate because you're looking at what the interest rate was yesterday. And so that throws up some issues. Now, I'm not going to spend time today talking about how you mechanically calculate what a backward-looking rate looks like for an interest period, although we could spend some time on that. But what we wanted to talk about was that gives rise to a problem when it comes to Islamic finance. And so I'm going to hand over to my colleague Shayan, who's just going to spend a few minutes talking about what that issue is from an Islamic finance perspective.
Thanks, Ollie. So as Ollie mentioned, he's gone through some of the key differences between SOFR and LIBOR, and this is of particular interest from an Islamic finance perspective. Essentially, the backward-looking nature of SOFR, which Ollie mentioned, is potentially problematic in the context of Islamic financings, which, if not provided in local currency, are often denominated in US dollars within the region. From a fundamental perspective, one of the key Sharia principles is gharar, which is uncertainty. And from that Sharia perspective, there needs to be absolute certainty on all fundamental terms of financing. And that includes things such as price, time of delivery, and subject matter within the context of a particular transaction. In the absence of such certainty, a contract may be considered void. So in practice, this means that the floating rate needs to be fixed at the beginning of the relevant calculation period. And therefore, for that particular reason, using a backward-looking rate such as SOFR on the face of it conflicts with the Sharia principle of gharar. And as Ollie mentioned, as lawyers working with sort of bank side and corporate side, one of the things that we're trying to see is how best we can balance everyone's needs and come up with a way that works for everyone, including the various Sharia committees at those relevant institutions. So a lot of banks and participants within the Islamic finance realm have been considering the best way forward in light of LIBOR transition. I think taking a step back, it's probably worth highlighting the nexus between Islamic finance and project finance, which is something that we see quite a lot of within the Middle East and elsewhere. Islamic financing is in essence asset-based, and that's why project finance lends itself well to incorporating Islamic finance structures. So Istisna Ijara and Wakala Ijara are the most common forms of Islamic finance, project finance structures for sort of large, longer-term financings. Each of these structures works on similar basis of both a pre-delivery and post-delivery phase, and this is tied to the construction of the underlying assets, again demonstrating why sort of the strong nexus between project finance and Islamic finance. So although we can go into the specifics of Islamic finance, and that could be a session of its own, we just wanted to touch upon the high-level terms so that this helps understand sort of the overall context of the SOFR mechanics and the like. So in very high-level terms, pre-delivery is the procurement phase. Here, the project company agrees to procure, which is basically construction, the assets for the financiers by a certain date, and that date would customarily mirror the project completion date with the conventional lenders. Typically, payments during this phase would constitute phase or stage payments, and then advance rental payments, which are equivalent to interest during construction under a conventional facility, so we can see the parallel between the two. Upon the delivery of the assets to the project company, at that point, the title to and possession of the assets passes to the Islamic financiers, and the assets are then leased to the project company under a forward lease agreement in return for lease payments. And these would customarily comprise of the fixed amount, which equals principal, a variable amount, which is equivalent of interest, and it's within this portion that the whole sort of SOFR element is particularly relevant, and then finally a lease service amount. And this overall section is during the operating or post-delivery phase of a project. And I think it's worth to note that whilst the forward lease agreement is, from a structural perspective, normally entered into at the same time as the procurement agreement, the actual leasing itself would only commence once the asset has been delivered. So as mentioned, in recent months, banks have been considering the conflict between the backward-looking nature of SOFR and the Sharia principle of Ghurār. And although Sharia committees continue to evaluate the structures, two possible ways forward that we've seen recently are term SOFR and what we've coined the adjustment method. In very brief terms, because then Ganesa and Edmundo will be able to speak further to each of those approaches, term SOFR, like LIBOR, is actually a forward-looking rate, and therefore it can be used to calculate the amount of interest that will be due in relation to an interest period at the beginning of the interest period. It's based on market expectations, but unlike LIBOR, doesn't include a credit risk premium. And I think because it is a forward-looking rate, that eliminates sort of the uncertainty principle that we've just mentioned. The second sort of scenario that we've seen is the adjustment method. And in high-level terms, this is based upon the principle of having an initial formula, which is applicable from a calculation perspective. And within that formula is a fixed increment. And that could be whatever is commercially agreed 2 times, or sort of something that's quite inflated. And this provides the financier in question with the comfort that such rates will always be greater than the reference rate because there is an element of inflation. From a structural perspective, prior to the end of the current period, the lessor will be required to provide the lessee, the project company, with an updated benchmark amount. And that will be based on the then applicable compounded reference rate to keep things current. And the borrower will have the option to elect which rate is applicable for the period, either the existing high one from the beginning or the newer current one that's been just given to them X number of days before the end of the period. I think the point here is that given that the initial formula included that inflated fixed increment, the expectation would be that the adjusted amount would always be less. And in more cases than not, the expectation would be that the lessee, the project company, would opt to pay this amount, which means that it's always going to be less than the high amount that was certain from the beginning. And that sort of, again, eliminates the uncertainty that Sharia teams are trying to mitigate against when coming up with the structure, given sort of SOFR and the issues that we've talked about. I mean, we're very fortunate to have Ganesa and Edmundo both with us here today, both borrower and lender side, to discuss these options and related considerations a bit further. So I think that's sort of an overall summary, and I think sort of provide the flavour for sort of some of the themes that we're going to be discussing as we go through the webinar.
Yeah, so thank you, Shayan. So Ganesa, we recently worked with you on what I felt actually and feel is kind of a groundbreaking Islamic financing, because we use term SOFR, and actually, I'm not aware that there's that many term SOFR Islamic financings in the market. So it'd be great to kind of hear your views on that and how we came to identify and adopt that structure?
I'll definitely think it's good for the participants to hear from a developer perspective. I think last 12 months have been quite exciting. I think I remember with some of the participants here, we closed a landmark transaction, solar transaction in the region, where we started with what would be the benchmark transition be. At that time, I think it was quite, although SOFR was there, I think we were still discussing how we transition from there to here now, within the 12 months, going through compounded SOFR and finally closing a deal on term SOFR has been quite exciting. So the deal in particular that we closed was in relation to a large corporate facility used for an acquisition. So in this sense, there was no pre-delivery and delivery phase as it was ready. So we could have, we primarily used a Murabaha structure, which is more straightforward. So there were some operational challenges as well. So what started as a conventional facility with a compounded SOFR, initially it started with a LIBOR, in fact, because it was in the middle of early of 2021, we had got a LIBOR approved commitment from the bank. But given the prolonged decision with the sellers, we had to be conscious that there may be a situation where we ended up the financing documents in 2021 with LIBOR, and there may not be no hedging available beginning of 2022 on LIBOR as well. So we took a precautionary approach. So even though the whole market, as you said, this was one of the first few transactions in the region, as a precautionary approach, we converted the whole documentation again to compounded SOFR so that even in terms of overslip, we made sure there is no exposure. And again, from a compounded SOFR, again, we had to change to a term SOFR due to a certain internal policy requirement, which we required the documents to be Islamic. So we had agreement with a large Saudi bank on the compounded SOFR, which took a lot of time and effort. But again, when we wanted to use the same thing for a Islamic facility like Murabaha, I think given how nascent things were with the bank in the region, there was a challenge of implementing the compounded SOFR in a Murabaha document. So the bank was not ready at that time, I would say, because when you take the compounded SOFR into a Murabaha document, I think you'll have to fix the profit rate on day one. So which means, as Shayan was saying before, we had to fix a sort of a ceiling or a notional amount, which then has to be back calculated towards the end. The agency team at the bank at that time was not set up. So the firm preference from the bank side was term SOFR. That's how we came to be using term SOFR. A lot of discussion that happened on the compounded SOFR actually helped us move transition a little bit faster. But one of the primary concerns at that time we had was because the term SOFR was relatively new in terms of liquidity as well. Like we were worried, like how does it affect the overall economics of the project? So we had to undertake a lot of exercises along with the banks and the treasury to make sure that we had run scenario sensitivities to ensure that both from a derivatives market perspective, interest rate swaps, and from a forward curve perspective, more or less we are neutral, that such transition does not affect us. Fortunately, in this instance, look, we've been also quite active in submitting a lot of bids for the last 12 months. I would say 3 to 4 bids we have done. We have seen different positions taken by different banks. There are banks who are willing to provide loans in terms of offer, but they're not willing to hedge. The hedging, the derivative schemes is not still yet ready. There are banks which were providing LIBOR rates with the base cash included, and then having some sort of a transition later on. So fortunately, in this instance, we were able to agree. The bank was ready to provide us the terms of derivatives, which we expect to close very shortly. And we were able to fortunately close both the hedging documents and the base documents using terms of the transition from compounded SOFR or LIBOR in this instance was very easy. So as compared to a compounded SOFR, it was a bit of a prolonged discussion that, again, there are not enough precedents in this region. As you would know, I mean, most of our industry is driven by precedents. So when you are a pioneer in this sense, I think it was a lot of negotiation. I think both the bank side and our side had like difference in opinion. Should it be cumulative? Should it be non-cumulative? What should be the look-back periods? keeping in mind that the decisions were happening before 7 or 8 months, right? So at that time, there was still lack of clarity. So compounded SOFR took us a bit of a time. Term SOFR, in that sense, it was a bit more easy. It was like people who have been used to LIBOR, the transition was a bit more straightforward. The documents actually got a little bit simplified when we moved away from compounded SOFR to term SOFR, because effectively it works in a similar way as term SOFR. So in terms of the key question you touched about on baseline credit adjustment spreads. So because the deal was being done towards Q3, Q4 21, the banks, still the thought process was set up in a way that they were transitioning from LIBOR to SOFR. Of late, we have seen in the newer bids, the banks are willing to quote, or they've started quoting on purely on SOFR without no adjustments required. So it's kind of very recently, almost most of the banks we are seeing is like SOFR plus margin. But at that time, like end of Q3, Q4 2021, although the documentation itself was supposed to be a term SOFR, so there was no need for a credit adjustment spread. But the bank's systems and the thought process was not ready at that time. So we had to accommodate the bank request to explicitly include a baseline credit adjustment spread. And that in itself is a big topic. But overall, I think there was a bit of a to and fro. There was a recommend from the bank to keep it floating, or should it be fixed to the 5th of March 2021. So it took a bit of a to and fro. Finally, we were able to agree to a hard number linked to a certain date. But I don't know if there is any other particular topic you'd like to touch upon.
No, again, so that's a very interesting, overview of the process. And one thing I would say, on the credit adjustment spread discussion is that, one of the guiding principles from the regulators for the LIBOR transition process is that there shouldn't be a transfer of economic value from the borrowers to the lenders and vice versa. And I think, broadly speaking, that has proved to be the case. And as you say, it is interesting, to those of us participating in the market, the banks are now sort of quoting on SOFR because LIBOR transition, as Edmundo said right at the beginning, it's done now, and going forward we're in a SOFR world. Edmundo, I know that obviously you're hugely busy, and thank you again for sharing your time with us today, but Abu Dhabi and Islamic Bank seems to be on every deal that we see at the moment, and so you obviously have got a very wide view of the market in terms of the different approaches for Islamic finance in a SOFR context. We're obviously very interested to hear your views on kind of the pros and cons of the term SOFR method versus the adjustment method. And, again, we've been fortunate enough to work on a deal with you where we've used the adjustment method instead of the term SOFR method.
Sure. So I will give my views on the overall transition from LIBOR to SOFR. I think obviously it's a reality, and LIBOR was a tricky one because obviously these major banks setting up a rate which they are beneficial of it. It's been proven in the market that there's been some kind of not too well judgment on that, and some collusion maybe. So now we move to SOFR. Okay, SOFR is obviously the overnight secure finance rate, which is collateral by US Treasury. So it's the closest you can see to a risk-free rate. Okay, obviously this is the New York Fed published that on a daily basis, and it's based on data provided by Bank of New York Mellon, by GCF repo transaction data, and some other unilateral data. So the spectrum, I think the reliability of the data is going to be there. So on that aspect, I think, and from an Islamic point of view, actually on interest rates and cost of funds, let's put it that way, is beneficial. I think it goes more from the Sharia principle. So that's a good thing. Now, the question is from a bank's perspective, cost of funds, okay, is this a rate that is reliable? Obviously, the banks don't fund themselves only on the repo market overnight secured. So there is another cost of funds. So that's where the credit adjustment spread comes into play. So the credit adjustment spread is something that is published by Bloomberg. Okay, we did some analysis on what will be a swap rate on LIBOR or SOFR, and the difference actually was exactly the credit adjustment spread. So that's how it's a little bit calculated. So the problem is that it's dynamic. The market is dynamic, the cost of funds of the banks are dynamic, and this, what we have seen, which is basically 11 basis points and 26 for 1 and 3 months, is changing. Okay, so I think this is only for a transition period. Going forward, what we will see is that margins will be adjusted for banks' overall return to be acceptable. Okay, and this is a trend we are seeing. Okay, now on the actual SOFR and the difference between adjusted SOFR and term SOFR. From an Islamic perspective, we would love to use term SOFR because it's forward-looking. It doesn't create any issues. The reason why it's not so much used in the market, especially for project finance, kind of underlying long-term, is because you need to hedge profit rates, the interest rates. And term SOFR is not liquid enough for hedges to be placed, right, using the term SOFR. And as you know, term SOFR is CME provides it and is based on market expectations. Some derivatives are put into place. I think term SOFR will develop. Adjusted SOFR is what it is. Term SOFR will develop, will get some depth, and probably is going to be, my personal view, is going to be used more and more in the future when it gets more liquidity and depth. So, and as Shayan mentioned, the issue from Islamic finance is an adjusted SOFR is the backward-looking component. So, and I'll put it in very simple words, is when you enter in a rental period on a forward lease, you need to provide the rate at the beginning of the period. The issue you have, obviously, on adjusted SOFR is that there is no rate. So how, from a Sharia, you have to do it. There is no way. It's like the example we always use is we are renting an apartment, right, to the tenant. How can I rent the apartment and at the end of the period, I will tell him how much the rent is? It doesn't work like that. So that's a bit Sharia. Obviously, on Islamic, the asset is owned by the bank and is leased to the project company, right? So the way we came up with, and as Shayan mentioned, is that so we'll give a reference rate at the beginning of the period, and the way we do it is that reference rate we're gonna inflate. We're gonna make it much higher than what we expect to be at the end of the period. I mean, these periods usually are 3 months period. It's not that they're very long, or even 1 month period. So we give these reference rates very high, and then at the end of the period, or maybe 5 days before, depending on the backward looking, we give the actual rate. The obligor here, we cannot impose a rate, so we tell them you choose between the two of them, and we understand that it's going to choose the lower one, so that's why we inflate the previous one. So that's how then there is some adjustment, which is more of an accounting for the termination value, but that's how we cope with the adjusted SOFR Islamic calculation or methodology. I think it works, and it's proven that it's worked because we've done it in a couple of deals already, and I think that was a little bit or a long process with our Sharia board, we have scholars in our Sharia head is a scholar. He's the one who really is in the front of all these new transition from Sharia perspective, and he's very let's not say flexible, but he's very aware of the market and how to accommodate and at least be a market player from Islamic. Other banks we have seen, they are not, they follow different approach. We follow IOFI standards in the UAE. Some Saudi banks, they don't follow IOFI standards, which are a little bit less strict, let's put it that way. But at the end of the day, the Sharia principles, these that you have to provide a rate at the beginning of the period is basic. So that's that's how we are doing it. I think it works. I think it's obviously especially when you have conventional and Islamic dual tranche financing, which is usually the case. It makes it it makes it work for both, because you don't want to have huge discrepancies in methodology between the conventional and Islamic. And I think we have achieved that. And obviously, as I mentioned before, it's a dynamic market, and we'll keep on kind of improving and making it better. But as of now, the good news is that we have a solution, and it's been proven and tested in the market. And as of now, is what we have.
Edmundo, let me ask you a question about hedging, because it's interesting what you say about term SOFR and hedging and project finance, and I would agree with that, because obviously one of the key risk mitigation policies or practices for banks and borrowers is to make sure that they hedge their floating rate interest exposure throughout the life of the loan. And it's kind of ironic that term SOFR, which I think you said, and I think Ganesa said as well, it's a really neat solution from a documentation perspective, because it's forward-looking. Everyone understands how a forward-looking rate works. But the problem with the term SOFR market is that it's basically the same as why we replace LIBOR, because it's based on market expectations and it's in a liquid market. And here we are, with a solution that has the same failings as what we replaced it with. But putting that to one side, because you can't so easily hedge term SOFR, you obviously might find yourself drawn to the compounded SOFR adjustment method. How does it work with that reference rate and the hedging, and when you're doing it alongside conventional banks? Because that you wouldn't hedge for the big number, would you? You just hedge for what?
So, sorry, just to understand. So obviously, one important thing about the term SOFR is who provides the rate, right? I think when LIBOR is provided by the banks, you are judge and party to the same equation, right? So there is a potential conflict of interest, right? CME, which is an independent group providing this rate as of now, I think it has less conflict in the whole picture, right? And obviously they have to disclose what methodology they're using. I think the evolution on term SOFR will be probably or more detailed, or other providers, or there will be a contrast of other players in the market for this term SOFR rate. Okay, so I think that's on the swap is very interesting, because when you are hedging SOFR adjusted, it's so obviously you have to look, in order to hedge, there has to be a forward curve, right? So, but this is a backward-looking rate. So how do you do it? No, that's the big question. And the truth is that right now what they do is the LIBOR curve, which there is going to be non-published, but there is published right now. They kind of use the forward, the LIBOR forward curve for the implicits of the hedge, and they adjust by the SOFR credit adjustment spread. So it's not, at the end of the day, is even though that we're talking on SOFR, there is some references to LIBOR already. It cannot be otherwise, because this is a transition, right? When LIBOR will be not published anymore in any screen, then obviously SOFR will see how we do the forward, but there is no such forward SOFR on the adjusted basis. So the reference will have to be term SOFR, and which is a good one, but you need a little bit more liquidity.
Yeah. And Ganesa, just on that liquidity point, I guess, from Aljomaih's perspective, I think there is quite a lot of liquidity from the Islamic banks in the market. And so going forward, I would imagine that this is something that will become a fact of life for you guys, whether it's the compounded adjustment or the term SOFR way of doing it. But, we now have them.
Yeah. I think not only the Islamic banks, I think the way we see it is, I think what we're still struggling to understand is how are the banks pricing in the first place. So we have seen difference in opinion. So some of the banks have come to us and said, look, our pricing works in terms of SOFR. So again, we can quote only in terms of the underlying price. but at the same time, they do recognize and understand the hedge market is not enough liquidity. So as a compromise, what we have seen, even some of the international banks providers, they're willing to do the term SOFR hedge, but with additional adjustment spread. I mean, additional spreads, let's say another 5 to 10 basis points, which does not help in a really competitive environment such as this. But overall, again, this has been like quite a evolving phase. The same banks who have been saying that in the last 3-6 months before, and we have now seen them evolve bit more, be flexible. So what we are still struggling is what is the underlying rates of the banks? Are they going to go the compounded way, or are they going to go the term SOFR way? That is still a bit unclear to us. I think there is still, at least as of now, what we see is most of the banks, even in the Islamic side, I think there is a consensus building towards the compounded SOFR, especially in the long-term financing, very used Ijara sort of products. Hopefully, term SOFR is a bit more easy, bit more straightforward, easy for us to use. So, but at the moment, we do not see much of term SOFR being used in our recent bids. We hope as the liquidity develops, I think in terms of evolution of term SOFR, it's behind. I think compounded SOFR was adopted by ARRC in the first 6 months or so before, and term SOFR was later then developed. So hopefully, as we move forward, we are hoping that term SOFR liquidity deepens, and that will help us enable and the banks to move towards the term SOFR, which we think is a bit more easier product and a straightforward product to deal with in terms of documentation, in terms of pricing, so on and so forth. For example, when we dealt in this current instance, the documentation, we had to rely on the LMA exposure draft to come to a consensus, right? So there is no, as of today, we do not see there is no precedent when we entered into. So again, even simple thing as how was a term SOFR defined? There was a fundamental difference between, what Bracewell was telling us and what the other legal lenders, legal counsel were thought it should be. So we were taking help in terms of LMA exposure draft to come to a consensus, but yeah, we're still not fully there in terms of term SOFR.
Yeah, I mean, one of the interesting things that we have spent a bit of time talking to, our clients and other law firms about when it comes to term SOFR is, what the fallback rate should be. And I do think actually that's particularly interesting in the context of the discussion we're having this morning on Islamic finance, because, and what I mean by what the fallback rate is, what happens if term SOFR is unavailable, so you can't get the rate from CME. What should be the interest rate that's applied? And if you went to compounded SOFR, and Edmundo, I'm going to come and ask you this question in a second, but I don't think that works from your Sharia committee perspective for the reasons we've discussed, because of the uncertainty element of it. And then if you went to cost of funds, I don't think Ganesa would be particularly happy with that, because that's not, also what, people have in mind for what the interest would be at the outset. So Edmundo, I don't know if that's come up in your discussions internally when you're considering term SOFR or not.
Well, this is one of the issues we have faced. The issue with a replacement rate or fallback rate is that, going back to the example of the apartment, right? I cannot impose a rent to my tenant, right? So we need to find a solution, something that makes sense, okay? From a conventional perspective, it's completely different because they can impose a rent, let's put it that way. So the way and especially all the deals we have done are a dual tranche between conventional and Islamic. So the approach we have taken is whatever the rate that is provided by the conventional banks, we just provide that rate, the same rate. Okay, so we take like a backseat position on this situation. And the issue about Islamic is that obviously if they don't accept the rate, they have to terminate the contract, right? So there is our comfort, really. The clients don't like that, obviously, but the thing is, you already agreed to the rate from the conventional. There is no reason why you will not agree to that same rate for the Islamic, even there is a much higher consequence if you don't do it.
Yeah.
So that's the way we do it. So look, I think there is some uncertainty here in going forward. I think given the nature of software, adjusted software, I think is going to be available because the world, as long as the world keeps on turning, there's going to be overnight kind of repo, and this is part of the most basic kind of overnight financing. That will be there. In terms of CME not being able to provide term software in the future, higher uncertainty. I think there will be other players that could take that role because it doesn't look that complicated. And I think for the market benefit, there should be other options in case something happens to CME, which is a company, that if they don't provide it, there will be an alternative from a different provider on the same terms, let's put it that way. So yeah, that's how we see it. At the end of the day, we are in the beginning of a journey that it looks like it's going to last for a long time, and it will get better and more efficient. But yes, there are some questions on this new venture. Yeah.
Yeah, I think that's right. I mean, I think if compounded SOFR, if the rate's not published by the Fed, then we've probably all got bigger problems. It is interesting, and this is not necessarily specific to the Islamic finance context, and also it's not necessarily an issue for financings in the region. But I think for project financiers in general, I suspect, and Edmundo, I think you said this at the outset, that term SOFR may be where we end up, because in a lot of jurisdictions where project finance is used, specifically in the emerging markets, you have exchange controls, and so there are restrictions on changing local currency into US dollars. And so typically, and we haven't talked about specifics this today, but typically in a compounded SOFR financing, you might have a 5 business day look back period, and that's the delta between the interest period and the observation period during which you measured compounded SOFR. And 5 business days simply is not enough time to get all the pieces of paper that you need to convert the local currency into US dollars to make a payment to the international bank as part of your cross-border project financing. And so for that reason, I think that the term SOFR market will become more, or term SOFR will become more liquid, and the term SOFR project finance market will expand in size, which I guess going to the point Ganesa, you've made it will make it easier to hedge, which is obviously fundamentally important for project finance transactions. So we're coming to the end of our session this morning. So I'm just going to kind of wrap up now by thanking our guests, Edmundo, Ganesa, Shayan. Thank you very much for a really interesting discussion. It's definitely an evolving marketplace. There's obviously some kind of key points, not least in relation to making sure that there's no transfer of economic value between borrowers and lenders, but also the approach in terms of the Islamic banks and Sharia committees and making sure that, which I think we've collectively in the industry done a good job of making sure that we come up with a structure that actually can sit alongside conventional financings or ECAs making direct loans, and it is sufficiently straightforward that market participants can understand it and hopefully replicate these structures going forward, because Ganesa, as you said, a lot of what we do for good reason is quite precedent based, and it's very exciting for all of us to be at the forefront of developing a structure that works for the market going forward. So thank you, Edmundo, thank you, Ganesa, and thank you for everyone, all the participants who are giving up their time to listen to us speak this morning.